Hello, everyone, and welcome to tonight's session of TradeFinder Live. My name is Zach. I'm one of the team here at Elliott Wave Options, and I'll be facilitating this session tonight with our speaker, Rob Roy. I'll introduce Rob here in just a few moments, but first we need to cover off a few important details about the session. First and foremost, this is our live disclosure disclaimer agreement. If you've seen any of our previous sessions before, maybe a TradeFinder Insiders meeting, and you've seen this, the main thing to take away from it is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. We do have this on our website to be read in full detail there, or feel free to take a screenshot if you like, but that's the main point to take away. So for this session, there's only one method of asking questions, and that's going to be the Q&A window, as you can see circled on the screen. At any point throughout the session, please feel encouraged to write your question in through there. And the question portion is a bit brief at the end. We just open it up to a few questions from both Zoom and YouTube. So just try to pass it through, and we'll do our best to get it through. And if just time runs out, just know it has nothing to do with the validity of your question. We just only have so much time for this session. Secondly, we have the chat window there. Rob can't take questions from the chat window. It's solely from the Q&A window. So the chat window is for all attendees interaction, and any support related queries, pass them on through and I'll be able to assist there. Other than that, when we get to the questions, we are going to limit it to two per person just to allow enough time for everyone's questions. But again, it is brief. So if we don't get to your question, be sure to come back on Insiders when there's much more of a focus on that portion at the other half. I think that about wraps up all the important details. So at this moment in time, I'll go ahead and introduce Rob Roy.
Hi, everybody. Switching this over to make sure you can see my screen this time. And here I am, hopefully so. Now you have to look at me as well. But welcome to this week's TradeFinder Live. If you're brand new to TradeFinder, welcome. I know we added a few more from the last couple of recordings that we did. Another Chuck Norris thing. Don't have the hat on tonight, but for those of you that may have just signed up for our TradeFinder by going through and subscribing to our channel. Welcome and thank you. We did hit the 30,000 subscriber mark, so we're pretty proud of that. And we do appreciate your support. Hopefully you'll find this very informative use of your time. So how TradeFinder works, if you're new, is we'll talk about the markets, not just the US market as it says there, but we'll cover the other markets as well. A lot of people ask about the international markets, so we'll go through that. Then we'll review a previous case study that we did with our Trade Alert service, give you an idea of how that works. And then we'll look at our recent case studies from TradeFinder. Case study considerations, I call them, because the difference between that and the Trade Alert service is we just identify something that you might consider placing a trade on, but from that point, you're on your own. With the Trade Alert service, we walk you through from start to finish, right? Send out alerts at the entry, any adjustments in the meantime, and when to exit, or at least when we exit, we notify you that. Of course, it's your choice to go from there. So that's the difference. There's not many that we have that I would consider still open. If you've been following along, for those of you that have been watching TradeFinder for a while, so we may have a little more time for that Q&A session tonight, Zach, because of the fact that we won't have a whole lot of time going through previous case studies. There's only two of them, and we're probably going to cross one of them off tonight. And so that general Q&A is usually you guys giving us your favorite symbols, and we take a look at what our indicators may have to say about those symbols. And based on our track record for our case study considerations here at TradeFinder, I think you probably want to hear what our, at least factor in to your decision making, what our technical indicators say about it. So with that, let's go ahead and take a look at the market. And we open to the upside today based on the fact that the CPI was still hot. It was a little less than what some whisper numbers were, but it was still high. And so I've been joking about this before, but it's not really a joke. Where we started, where we're like 1986, as far as the worst inflation data since, and then down to 84, 83, 82. Now we're at 81. And I've talked about the fact we don't want to get into the 70s because the decade of the 70s was not a fun time. Really high inflation, really high interest rates. And boy, if it doesn't seem like we are heading there, but I hope we don't. I hope we don't repeat the decade of the 70s, but that was the big news. So market seemed to like it in the beginning, but really all we did, let me take these moving averages off, was go up and fill that gap that was created yesterday on the downward move. So we had a little bit of a gap there, moved up, filled the gap, and then closed near the low. Now the futures are up 17 right now. So perhaps we get another little bounce at the open. As you know, long time between now and when the market opens tomorrow. If we look at the moving averages, we are a little bit oversold from the 10-day moving average, but nothing significant. And we're dangerously close to having another negative 1030 cross, meaning the 10-day moving average crossing below the 30-day moving average. If you are new, and by the way, welcome to all of you that are live streaming. We really appreciate that. This new era of live streaming on different social media services. So the 10-day moving average is that lime green line. The 30-day is the fuchsia colored line, and the 50-day moving average is that royal blue line. So you can see that the market just, all it did was close the gap and hit the 10-day moving average on the high, and then we closed down here, but we closed low enough from the high of the day that it actually created a little bit of separation. But as you can see, the 10-day is getting very close to crossing below the 30-day moving average. Why is that significant? Because a lot of the floor traders watch that as far as indications of where the near to midterm trend may be. 1030 cross to the upside would be bullish, 1030 cross to the downside would be bearish. And I've got a lot of friends that are ex-market makers, ex-floor traders. They're the ones that tell you what really goes on, the ones that are still trading. And I know there's a lot of electronic trading, but the ones that are still on the floor, they don't really want to tell you what they look at. So you have to talk to the guys that are retired and not tuning anymore to really find out what happens on the floor. So this move back to the upside, it was enough that it disqualified our downward zigzag pattern, but just barely. So if we take a look at this and go from the high down to this low, you can see that, well, on that one, technically that big zigzag hasn't been disqualified. The one I was referring to was the one that we were watching before, where we had this initial move lower, and that was here, and then bouncing back up. So if you look at the 78.6% level, which is the official disqualification, that zigzag pattern is actually still in play. So we just took out this high, but we could be looking at, and let me give you the level here if you're curious as to where we could be going down to. I see it's 74%, so it didn't quite make it to 78.6. Now, Elliott, if he was here, would have said, I don't like it when it hits 70%. He felt like the majority of the time, if you had a 70% correction, you're going to hit 78.6. So he'd go ahead and write it off at 70%. But if you're following the letter, and we talk about this a lot, and it's in our education, we really pride ourselves on our Elliott Wave education at our website. So if you're fairly new to Elliott Wave, we've got I think the best Elliott Wave education that exists out there. We get a lot of favorable comments about it. We're proud of it. We put a lot of time into it. Technically, 78.6 is the rule. And in our technical analysis and in our education, we talk about the difference between guidelines and rules. And so if Elliott would say, oh, well, it's 70%, usually goes to 78.6, that's a guideline. That's something that he observed. But the hard, fast rule would be a 78.6% Fibonacci level for the official canceling of it. So we'll see how it plays out before we break this low. Nothing really matters till we break 420. And so heading back down there, I had mentioned it was in, I think last week or 2 weeks ago, that the move was too vertical on this corrective move, and I felt like we would come back down. But we also have to acknowledge the fact that we do have a qualified upward zigzag. So you look, did you start at the bottom here? I like to start at where the impulse move started. So I wouldn't click here, or I wouldn't click down here. I would click right there, because that's where the A impulse actually started. And you can see that's pretty close to a 61.8% corrective level, perhaps why the futures are up right now. So we have two qualified zigzag patterns at this point in time, one to the upside, one to the downside. Unusual, but not unheard of. It happens. And so when you see that, you just err on the side of caution, which is what we're doing with our alert service. We have a number of alerts out, but probably not as many as we normally have, because you have two qualified patterns, one up, one down. So which one is going to win out? Well, we'll see. Obviously, if the market continues down and disqualifies that upward zigzag, then we know where we're going. But for now, you respect the potential for moves in both directions. And I know the Elliott wave haters get on YouTube and say, oh, well, you're saying it could move up or could move down. Now, way to go making a call. I'm not making a call. I'm reading the charts, and that's where we are. And so, if that gives the haters information or fodder to post their comments, go ahead. We have the AI data that proves Elliott wave works. So I don't really care what anybody else says. And I actually enjoy when the haters come on, because most of the time they're wrong, because Elliott wave works most of the time. Doesn't work all the time. Nothing works 100% of the time. It is wrong sometimes. I'm going to look you right in the eye. Elliott wave is wrong sometimes, but it's right a lot. And that's why we use it. So we'll see how that plays out. So I wish I could tell you the market's definitely going down or the market's definitely going up, but we have qualified patterns in either direction. So the market will tell us. I think if the 10-day moving average crosses below that 30, then you lean towards the fact that the downside zigzag pattern probably plays out. But if it doesn't and we bounce back to the upside, then you have to respect that's a very qualified upward zigzag right there, that could be the new pattern. So the market's going to tell us where things are going. The fundamentals aren't really helpful, are they, with everything that's going on from a standpoint of inflation, the Federal Reserve talking about, I mentioned in the last recording over the weekend that Fed Governor Brainerd came out and said they're going to be they're going to be reducing the balance sheet quickly. So you withdraw liquidity from the markets. That's a very difficult scenario for the markets to go higher. And I don't know how many people really fully embrace the fact that liquidity drives the markets. The Federal Reserve has been injecting liquidity. They've had easing policy for a while, and the markets went higher. Now they're going to flip the script and they're going to start withdrawing liquidity. Does that mean the markets can't go up? No, markets can still go up, but will they go up as high? Probably not. And it's a harder scenario for the markets to go to the upside. So again, it doesn't discount the fact that the markets could go higher, but it's more challenging, and you're likely not going to get the same kind of moves that we've had since the bottom in March of 2020. So I don't really have much else that I can say regarding the SPY. I want to show you the TNX and the dollar, and then we'll get to the other markets because this is not good. The fact that interest rates are flying high and that money is clearly not moving into the equities markets, at least not yet. So I had surmised over the weekend with this vertical nature of interest rates going to the upside, does that mean people are bailing out of bonds to go into equities? It hasn't proven let me try that again. It hasn't proven to be thus far this week, but we'll see what happens over the next couple of trading days. But if interest rates continue to go to the upside, with the fact that the Federal Reserve on top of that is going to be raising rates, and they didn't like that inflation number today, I can tell you that, and they don't want inflation to get away from them on their watch. That I can tell you as gospel. There's no doubt about that in my mind. So when you have the yield curve inversion, which we had, you want to see where the yield curve is now? Let's go ahead and bring up the yield curve right now. Has it gotten any better? Nope, still flat as a pancake. So there was some talk last week that the yield curve had steepened a bit. Well, there was a tiny little tick there, and then it went sideways. So no significant steepening of the yield curve. So rates are going up. The yield curve is still showing or gave us the signal. Look at the last YouTube update if you haven't seen that, to see the yield curve inversion. The last two, I think we talked about it with the fact that it has a 98% accuracy rate. And everybody's, oh, it's different this time. And I'm always saying that no, it's never different this time. 98% is pretty high. I'm talking about another's 100%. That's pretty darn close. So when the 210 inverts, just to give you the numbers, it tells you that there's likely a recession coming, 98%. There's a recession coming within 1 to 2 years. So it doesn't mean it's going to happen tomorrow, but it's coming. I mean, let's just say that 98% chance that we're going to have a recession. And normally when you get a yield curve inversion, you don't have the Federal Reserve just starting on a rate hike campaign and telling us that they're going to be withdrawing liquidity, doing it fast and loud, if you will, to borrow a name of a car TV show. But I'm concerned about the vertical nature of interest rates moving up and that not showing that money's flying out of bonds into equities. And then the dollar, I mentioned a while back that I thought the dollar would hit 100. It did, and it backed off, but not for long. Look at that. That's amazing to me. It hit $1 and it came, or hit 100 and it came right back. And then look at today, and we're in a wave 3. So the wave 5 target wasn't even at 100. It was down here around 99 or so. And I felt like, well, if it's going to get that high, it's probably going to 100. So we've relabeled into a wave 3, and the dollar still looks strong. Now, to me, that's a positive. So if you're looking for positives in the market, to me, the number one positive that I can find is the fact that the dollar is staying strong. If we were to lose the dollar, then we're looking at 2008 all over again. And some are saying that we may still look at some financial calamities coming up. But for now, I think the dollar staying strong gives us some hope from an economic standpoint that maybe it's not as bad as it could potentially be. But I do feel very strongly that the Federal Reserve will overshoot the mark. They're going to raise rates more than they need to stave off inflation. They're going to be extremely aggressive. They'll go too far. Likely we go into a recession, maybe a significant one. And then I think the scenario is pretty likely that they do. They've done this in the past before, where they have one meeting where they raise rates and then they cut rates at the very next meeting because that last rate hike just broke the back of the market. And then they realize, oh, we went too far. And they turn around and immediately start easing. You would think that you go through a rate hike cycle, and then you go sideways for a while. And then if the market hasn't gotten better, the economy doesn't get better, then you start easing a bit. But because they tend to go too far, you jump from raising rates to easing rates. And there's history to show, as I said, that they've done that before. So I do like the fact that the dollar is staying strong. So there's your positive moving forward. But there's not much else from a fundamental standpoint showing that the markets could rebound here. The sentiment is not overly bearish anymore. In fact, the sentiment got overly bullish, believe it or not. Just in this move here to the upside, we went from overly bearish sentiment to overly bullish that quickly. And so that's not in the market's favor either. So here's the Dow. And it went 73. So we had 74 on the SPY. So you can see they're pretty much in lockstep here. Not as big of a move to the downside on the Dow. As you can see, not quite as vertical of a move on the Dow as we have on the SPY. So that tells you that money is becoming a bit more defensive. So it's hiding in the larger companies, the more stable ones, if you will. So we'll see how that plays out. Perhaps you want to look at the transports. We looked at that in the last market update because a few of our astute viewers talked about, wow, the fact that the transports had crashed. Is that a positive thing for the markets or a negative thing for the markets? Yes. And that goes into Dow theory, where the industrials and the transports tend to follow each other. One can lead, the other one follows, and they're inverse. So it doesn't matter which one's leading, but that's pretty ugly right there. And then when you look at it, let's just walk back to when it was really bad. And so there's your vertical move down. And you know that I don't like vertical moves in either direction, because usually when something goes vertically one way, it goes vertically back the other. But so far, it hasn't. we've gone sideways, which is the other thing that can occur when something is too far away from the 10-day moving average. One of two things happens. It either rebounds up or down back to the 10-day moving average, retraces, if you will, or goes sideways and allows the 10-day moving average to catch up. And at this point in time, the transports have gone sideways, allowing the 10-day moving average to come and catch up. And so it's not nearly as oversold as it once was. But if you're looking for, again, another little tidbit that you can hang your hat on, maybe the transports hold here and we don't have a real dire scenario in the markets. But man, if we break through this level here, and we've been oversold, so the fact that we're consolidating on a level of support is not surprising at all. What would be positive for the markets is if we do bounce off of this level, retake that 10-day moving average, and get back up in this area somewhere where there's an area of some potential consolidation here. Maybe we get above that. It will probably bump our head there if we are able to get up to that level. And then if we could go sideways and then use that as the launch pad effect that I've talked about in the past, living on the Space Coast, kind of use the space analogies. That's your best scenario, that we bounce back up, get above this area here, maybe go sideways for a while and then have a way to break above that. But we're a long ways from that. So I'm just kind of throwing things out. But I thought I would bring the transports up since that was such a really vertical move to the downside. And that was occurring while the market was going up. And so there was your divergence. You're looking for divergent signals in the market. That was about as divergent as it gets. So the Dow has hung in there pretty well. The Qs, not so much. And I've said this so many times, it's on every recording that I've done over the past several months, the fact that I feel like the Qs are going to underperform this year. And just to clarify, for those of you that may be new viewing tonight, that isn't saying that the Qs couldn't end the year to the upside. What I'm saying is that I really believe, and history is on my side, when you move into a rate hike cycle, it's tough on tech stocks. So I feel like the Qs will underperform the SPY and the Dow, regardless of whether they finish down or up for the year. I think the Qs will underperform. Well, right now, they're in about as classic of a 5-wave impulse pattern to the downside as you could be. So there's 1, 2, significant wave 3, and the wave 4 right at the 61.8% Fibonacci corrective level. Pretty significant level. It's my favorite fib level. So it's really a strong point there. And so I feel like, it's going to be difficult for the Qs to break above that. They had a gap here. And so when you saw the rally this morning, you're like, okay, are we going to fill this gap from yesterday and go up and fill this one? Well, all we did was fill that one, and then we turned over. And isn't it interesting how the market, and this isn't done by design, this is pre-programmed in these time and price projection boxes, which is what the wave 5 down here is giving you the projection of where the wave 5 could go. But look how the Qs are going right along the dotted line. And so it's not designed for that to occur. It's just pretty interesting that it's just in lockstep of what should be going on as far as the Qs. And I know some people have said, man, if we get down that far, yikes. Well, we got to break 320 before we start talking about that. But so far, that wave 5 impulse pattern is as classic as it gets. And we'll see how that plays out. So if you're wondering about a zigzag there, is there a zigzag to the upside there? Let's go ahead and take a look. Certainly worth a try here. So again, I'm going to start on the bar where the impulse started and then come down and see where we are now. Haven't disqualified the upward zigzag yet. It's not as strong as the SPY, but it is just right in that 61.8% level. Perhaps maybe we try to hold here. We got a holiday weekend coming up. We'll see how that plays into the markets, etc. So for now, we'll see what occurs. But that 5-wave impulse pattern to the downside is playing out exactly as you would think. With the moving averages, tiny bit oversold on the low today for the Qs. Also about to have a negative 1030 cross there. Yeah, we need to see a pretty significant bounce here soon if the markets are going to stave off what looks like another significant move lower. And with the sentiment had gotten so overly bullish, and I know that doesn't make a lot of sense, but it did. There's not a lot of ammunition for the bounce. Sometimes that's the best ammunition when nobody thinks it's going to happen, but people got really bullish because of the strength. I think the vertical nature of the move. Everybody's like, "Oh, it's okay. It's back to buy the dip." And then what happened? The market rolled over again. Every time somebody gets, or the majority of people get on one side of the market, it tends to move the other way. And that's just because that's the path of least resistance. When you're trading, if there's a buyer, there has to be a seller, and vice versa. So when you get too many people on one side, it's easy for it to go the other way, the path of least resistance, as I said, and that moves markets as well. And that's one of the things that Elliott does, is it measures the behavioral aspects of the majority of traders. So sentiment plays in there. It's one of the reasons that it works so well. So not too good there on the Qs. Looking at the IWM with our new 2022 trading range, and just kind of staying in the middle there between this 190 and 210 level, just hanging around right in that area. And not much else to say there. It's pretty much gone sideways. So I guess you could say that at least that's not a real massive risk off scenario. The small caps at least hanging in a bit, right in the middle of the trading range, though. Looked like they were going to think about breaking out, but break the upside here on the 29th of March, no follow through day, back down. And that was when the market reversed and headed back down, right when the small caps were going to try to break out of the trading range. Not so good on Bitcoin either. And if you've been following along with this, pretty ugly there. And you look at the 5-wave pattern, also a really nice Elliott 5-wave impulse pattern to the downside. We talk about the fours. Everything is in levels of 4 on Bitcoin. So we came up, we looked at 48,000. It couldn't break above it. So then you look at 44 for potential support, because that's a support resistance area. I kind of hung around there for a couple days, and then just boom, as soon as they gave that up, no time, we're down here at 40. And at the time of this recording, it's just a little bit, or the time of this webinar, it's just a little bit below 40,000. And there you're about to get a negative 1030 cross on Bitcoin as well. But on the positive side, we're at a whole bunch of congestion here. So a lot of potential support right here in this 40,000 area. Even if it were to break that, there's still more down at 36. So perhaps we get a little bit of some sideways move here out of Bitcoin, a tiny bit oversold away from the 10-day moving average on the low, but that was just because of the big move lower. But again, a lot of congestion here. Good point for some support, maybe even a bounce back to 44,000 to test that level. We'll see how that plays out, but a break of 40 and you're down at 36, and you don't want to lose 36. If you're long Bitcoin, this is your line in the sand. You can't lose the 36,000 level. If you do, then it's 32, and then it's probably down here to 24, which is where the wave 5 target is. So kind of in danger land again here, but well, let's see if this congestion can help Bitcoin hold around 40, perhaps give 44 a shot, or if we just come flying down here to 36, then it's nail biting time, because that has to hold if we get to that level. The XJO for the Australian market, and really pretty good price action here, honestly, when they had this really vertical break from this about as nicely formed symmetrical triangle as you're going to see. That's as good as it gets. So trading the Aussie market on a strangle would have worked out well. You got a vertical move to the upside here, and now you're right at this area here of resistance, and it makes sense. It was a little vertical for me. I'd made the comments in some of the other recordings that would have preferred to see a breakout on a 45-degree angle, better chance of it holding. So running vertically right up to resistance, didn't feel like there was much of a chance that we were going to break through that level and then take off to the upside. And so consolidating underneath that level is actually pretty bullish price action. So there's still the chance of it coming back down because of how vertical the move was to the upside. But if this consolidation can lend itself to a break above this 7,600 level with a follow through day, then Australia could be off to the races. So we'll see how that plays out over the next couple of trading days. But that's about as good a price action as you could have hoped if you're long the ASX 200. And then looking at Canada, a lot of our subscribers have liked the fact that we've added Canada into the mix, but we did give up that 40 level and we lost the 5-wave impulse pattern. So that's no longer labeled. And now we're just looking at support resistance areas and breaking down below 40. It tested it and not a good day today. So the Aussie market, or the Canadian market was looking really, really strong along with Australia, and Canada has given up just a bit more than Australia has. But you can look at this, and we kind of noted this last week, that we've got a bit of a expanding triangle forming here, and you could say that we're at the bottom of it on that lower trend line there. And if we break below that, then we're staring here at 39, and from that area, it doesn't seem likely that Canada is going to fall a lot. There's some support here at 39. There's a ton of it right through here at 38. So if you're long the Canadian market, that's your line in the sand, is 38. That needs to hold. There's still some support at 37. So where Bitcoin drops in 4,000 increments, the EWC is dropping in 1 point. So we had support. That's now resistance again at 40, and then 39, 38, and some more at 37. So if it gives up 39, all hope is not lost. We still have some more in here, but I know that's getting down significantly again from here. But in order to get back on the bullish bandwagon for the Canadian market, we got to get above 40 with a follow-through day. And so far, with today's price action, it doesn't really look like that's going to happen. You could see that this sideways consolidation here was on lower volume, and that was a positive. And you can say, okay, well, we're consolidating underneath 40 here on lower volume. We're just taking a look at making another run. It was pretty vertical when we went here. I've noted that it was a pretty vertical move that broke above it. And that was all constructive. The fact that you're consolidating on lower volume, but then you have that big bar down on average volume, that's not constructive. So that changes things a bit. And that's not really what you want to see from the standpoint of turning around and heading back to the upside. Now we do have the 50-day moving average not too far away. So perhaps we come down, hit the 50-day moving average and stay above 39, gather ourselves, and then try to break back above 40. That would be, I think, the most bullish scenario for the Canadian market. Obviously, there's all kinds of speculation over with the war between Russia and Ukraine, wondering if Russia is going to, cross that line of using weapons that nobody wants to see used. And who knows how that plays out. Certainly that would affect markets if something really catastrophic came from that. They keep talking about peace talks, and they don't seem to gather a whole lot of potential over there. So taking a look at, and I'm going to bring this chart up here so we can look at recent case study that we closed on our alert service. And here's one in our time strategy, which the Chuck Norris thing that we just did, putting up your best Chuck Norris one-liner. This gives you an idea of how the time strategy works. This is AI based. We're actually infusing AI into our other portfolios as well, but this one is all AI based. And so this was a put calendar spread, and the average is around 21 days. So if you like shorter term stuff, so 37% return in 13 days. You see it got up there and came back down, got up there again. So 37%. If you know, with what we're showing, and let's go ahead and take a look now at our case studies here. Here's the SIL, which we looked at back on March 20. We only have two of them to look at, back on March 22nd. And so you take a look at that, and that was a pretty nice ascending triangle. Then you bring it forward to today, and you can see we're breaking out. So we talked about this last week, that the triangle had just formed a little larger. And when that happens, it's frustrating because it takes a little more time, but usually patience is rewarded, because when the breakout comes, it's usually a little bit more significant. So we look at the ADX, and you can see how low the ADX got. It got all the way down to 8.5, which is in the area of the lowest ADX that you see. Of course, it could go lower, but 8 is a really low reading on the ADX. So what does that mean? Means that a breakout is likely. So far, it looks like we're trying to break to the upside, but we don't have a confirmed breakout yet. You're like, well, 3 bars to the upside, but it's not how it works. So we had an upward break, but no follow through day, and another upward move. You have to have 2 consecutive days. So a follow through day or confirmation day for me is 2 consecutive days. You can get on the internet and read different viewpoints of follow through and confirmation days. But my experience, been doing this an awfully long time, you want that follow through to be definitive, and you want it to be the next day. And so since we haven't had that, we're still looking for that. And there's a little bit of potential resistance here. But if the SIL can get above this, then there's really nothing in the way stopping it until you run all the way up to 42. And why do I say that? Because look at the move down from there. Again, that vertical nature. So there's no resistance. If we can break above, if we can follow through this 38 and move to the upside, then we have clean air all the way to 42, and it should run there in a very short period of time. And then last week, we looked at Hershey. And so take a look at this, HSY, and we talked about how this was in a good sector. One, there's food inflation, right? We all know that. If you've been to the grocery store, you know that. And if you don't go to the grocery store, you're not eating. Even if you go out to eat, you said the checks are, 20-25% higher on average for food right now. That's insane, the amount of inflation in food. So it was in a good sector. Pricing power, if you will, and look what's happened just since last week. Boom! How about that move to the upside there? So if you want to take your gains already, if you look at the 10-day moving average, it's not tremendously overbought yet. So I wouldn't really fault you if you wanted to hang on there, but that's a pretty nice move. Now the spreads were a little wide on HSY because it wasn't the most liquid issue. So you have to overcome the slippage. So perhaps that keeps you in there a little bit longer. But the entry point was with the stock at 218, and we're trading now on the close at 226, hit a high at 227, almost 228 on the high. So almost 10 points that you got in 1 week off of Hershey Foods. So if you've been watching us, and I just showed you the result on our AI-based time strategy, which is performing extremely well. If you've thought about becoming an alert subscriber, there's no better time than now, especially with what's going on in the markets and the fact that there's this discombobulation here. We have a qualified zigzag to the upside or the downside. Which way do you go? Well, if you want some guidance, come join us. And as Zach said in the beginning, every Thursday we do another one of these webinars for our alert subscribers only, and it's longer, and the Q&A session is longer as well. And so we try to get to every question, if at all possible, within a reasonable amount of time. Again, we hold you by the hand from entry to exit on the alerts, rather than just saying, here you go, figure it out from there. Let's go ahead and take a look and see if we can find a case study consideration for tonight. And for those of you that are new or live streaming, I don't look at these ahead of time. I walk them through with you, and I feel like from an educational standpoint, that's better. If everything was preset and preloaded and already decided, then you don't get as much out of that, I don't think. So we try to look through and you listen to, I just think out loud, basically, as we go through and look at these potential results. And then I can see one already that pretty interested in, because we did CMC already, and maybe that one's showing up again. That could be leading towards that continued breakout in SIL, which again is the miners, not the metal SLV. But let's take a look. So we've got a food stock, we've got MSC industrial, Doji today though. But man, that's a good looking DMI. So let's take a look here. That is a really good looking DMI. Let's see if we're in an Elliott wave pattern. We are in a wave 3 pattern to the upside. That's going to be tough to beat. I'm not real familiar with this one, so let's take a look at the options and see if we have a lot of options choices here on MSM. Not a great number of choices, but the spreads aren't that wide. I was worried that this could be one where, you know, $1 by $9 or something, and so it's not tradable. But there's not a tremendous number of strikes, but the spreads aren't wide, so we're okay there. So that could be a good one. All right, I really want to look at these next two though, so that surprises me a little bit. Perhaps we'll kind of take a look at more than one tonight. Hormel, we're back in the food, so maybe you say, oh, we already got Hershey, so we don't need multiple ones in the food. But this is, you know, this is a sector that's moving, as I mentioned, for the reasons I mentioned, pricing power, etc. We're smack in that tap box. That's time and price projection. By the way, for those of you that aren't aware, this software program is called Profit Source. It's a product of the Hub Corporation, hubb.com. You can find out more about it if you want to go to their website. To me, it's the best Elliott wave software that exists. I've tried all the ones that I know to exist. And one of the main reasons is this is programmed directly to Ralph Nelson Elliott's algorithm. It's no personal adaptation there. So I think it's really cool. You can create your own searches. You can create your own portfolios so that you can paper trade, etc. It does everything you can imagine. So right here to the wave 5 high, that could be concerning. So what we usually do when we see that, you know, wave 4 right at 47%, so 50% correction, and we're right at the target, we look to see if we're going to have an extended wave. And that's where the DMI is our favorite confirming indicator. We have several confirming indicators that we use in our technical system in addition to Elliott wave. All of them are highlighted on our website, the education that I talk about. There's a session on every single one of our indicators, so you can learn about them. The ADX is moving up nicely. It looks like that positive directional indicator is trying to get back above there. So you're seeing some confirmation there that we could go higher. CCI is really kind of non-committal, but money flow is looking really good. So, you know, there's a pretty good case. If there was a negative, it's that it's hit its price target, right? So are you being greedy when a stock hits its target and then you expect it to do more? I think there's an argument for that. So again, that's why we rely on our confirming indicators to tell us, hey, are we being greedy? Should we just take this and run, leave it alone? But when you look at that, there's a case there. So I don't know that that looks as strong as the MSM does to me, but it still looks pretty good. And then CMC, I wanted to see this one again. We've talked about this one a couple of times. We highlighted it here, and boy, it looks like it wants to go again, doesn't it? Look at that. It looks like it's trying to set up. Still in a wave 3. Look at that DMI. We can't do this one tonight because the ADX hasn't gotten back above 20 yet, but holy cow, if it does, perhaps by next week. So I'm going to put this one over on a watch list. And yeah, I'm old school. I write things down. So I don't have any fancy. Well, I do have an Excel spreadsheet because there's mathematical formulas for helping us to decide which strategy to utilize in the AI-based time strategy. But I write a lot of stuff down. I feel like I learned in school that you remember things better when you write them down. So, I'm an old school guy. So writing things down helps to remember. And a couple things here. One, we're right at that recent wave 3 high. You can see that we took a look at it today and couldn't get above it. Let's look at the 10-day moving average. Not really that overbought, a tiny bit, but not that much. One concern here is we do have a tombstone doji here, which means that perhaps we back up a little bit. So we would want to see how that plays out. And we don't have the trigger yet on the DMI. It's setting up as nicely as it gets, but our subscribers know that we've seen setups like this, but that ADX has to not only be above the negative directional indicator and below the positive, they have to be separating, but the ADX has to get above 20. We've seen them come up here and then just roll over. Believe it, it happens. It looks that good. And you're like, oh, I'm just getting in early because it's going to happen. I'll get in earlier than the move and I'll make more. You got to let it actually trigger. So that goes on the watch list. As I said, for those two things. One, let's see what happens tomorrow with that tombstone doji. But if we could get a break above this wave 3 high and the DMI confirms it with a trigger, the separation continues between the two directional indicators and the ADX gets above 20, that thing's off to the races, but not yet. All right, so our case study consideration for tonight is going to be MSM. It looks really good. So there we go. Looks pretty good. All three of those looked pretty good. Hormel Foods, I think we can kind of put a little parentheses there on that one. What was the symbol? HRL. So we'll just kind of keep a note on that and look at it next week just to see what happens. But I like MSM better and pretty excited to see what happens over the next couple of trading days with CMC. So with that, Zach, we got 10 minutes to go, so we'll get a few more questions than normal. So let's go ahead and open it up to the Q&A.
Awesome. Sounds great. Well done again on staying on time. You've been on a roll lately.
Crazy.
Start out with this first one from George. There's a number of symbols here, so I'm just going to give you the first two, and that'll be BBBY for the first one.
Bed Bath and Beyond. Yeah, that's pretty ugly. So I don't know if we're looking for a bearish trade here. We're not in a 5-wave impulse pattern. It is getting to a point. Wow, we're getting the negative 1030 cross today. It's a tiny bit oversold from the 10-day moving average. And it's also at a major point. If it's going to hold, it's going to hold right here. So this is key on this one. What we do here, if it can bounce from here, then perhaps we have a chance to go back to the upside. But if it breaks below this 17.5 level here, with that being a pretty significant point of support and the potential of a 1030 bearish 1030 cross, then we're very likely coming all the way down here to 13 or 14. So what happens with this 17.5 tells you a lot. Otherwise, you have a pretty good downside trade there. So next one.
All right, next one's going to be NVIDIA.
Your favorite stock.
Indeed.
Did they really ask this, or do you just bring this up every single week?
I know how it seems, but I probably
no, I know everybody wants to know about NVIDIA. Now, NVIDIA is oversold. Okay, so if it's going to hold, it's going to hold right here. So maybe this is why we're seeing the bounce in the futures, because we're kind of we're at the point of we need to hold right here kind of mode. So 220, there is the point that needs to hold. We are a bit oversold on NVIDIA from the 10-day moving average. So that gap didn't quite get filled today, I don't think. Doesn't look like it. So the low was 230, high was 2. Yeah, so it didn't quite fill that gap. So maybe we get a little bit of a bounce out of NVIDIA, but it's going to have a hard time getting back above 240. If it can, then maybe we have something different to the upside. But if it follows through this break below 220, And I don't know that that happens tomorrow because it is a bit oversold. There's that little gap there. So maybe it churns in here between 220 and 240 for a couple of trading days. Let's the 10-day moving average catch back up. But if it breaks below 220 tomorrow, if there's a follow-through day tomorrow, then you're probably coming down to this wave 5 target here, right around 170. So yeah, do or die area right there, 220 for NVIDIA.
Awesome. Thanks, Rob. So at this point, we'll transition back over to YouTube. Chad asked if you could look at gold, and in addition, I believe Thompson actually from Zoom asked if you could look at gold as well.
Okay. So I looked at, I didn't even look at silver. I looked at the miners. So we should look at the metals. So you can see that, and we talked about this over the weekend, right? If you looked at the SPY update over the weekend, we talked about the triangle here. It was pretty well formed. Now, what I was talking about before, as far as a breakout and a follow through, that's what we're looking for. So it broke out yesterday and it's to follow through day to day. So that doesn't mean it can't come back and test that breakout, but that's a confirmed upward breakout, which means we're likely to continue higher. And you can see the wave 5 is way up here. And we're in an environment, right, with rising rates, inflation, et cetera, where you could see a move. And it's counterintuitive, right? Because the dollar is going up too. So when you see that and you see the dollar going up and the metals are going up, like what in the world is going on? Really big concerns about inflation. That's what's going on. That's about the only time you would see that kind of a scenario. So if the dollar does calm down a bit, which I think very well could, I've been super impressed that the dollar stayed as strong as it has. It's already hit the target I thought it was going to go to. So that backs off, then you can really take off to the upside here, but a confirmed breakout to the upside on gold. And right at that wave 4, 61.8, again, my favorite fib level. Chart of gold looks really good. So I think silver probably looks the same. I might as well, somebody's going to ask about silver if I don't bring it up. So let's go ahead and look at the metal. We looked at the SIL was breaking to the upside, it's the same chart, see? And they're not always, right? Slightly different pattern here. Whereas on the SLV, it was more of a descending triangle. And I've talked about this a lot for those of you that are newer viewers. It's a really nice marketing piece to say a descending triangle is likely to break to the downside and ascending triangle is likely to break to the upside. Symmetrical triangle can go either way. All of them can go either way. There's no definitive data that says a descending triangle is likely to break lower or an ascending triangle is likely to break higher. Maybe they do, but it's not because there's any magic in the formation of the triangle. They're all triangles. They can all break in either direction. So in this case, the descending triangle has broken to the upside with a follow-through day. So that looks pretty good. Some resistance here at 24 on the SLV, but if we could get above that, it's gone and off to the races as well. No 5-wave pattern here, just corrective moves, and that's the triangle here. In GLD, there was a triangle within the Elliott wave pattern, but not on silver. It's just a corrective pattern on its own. So what was the other one? I'm sorry, I jumped in there with SLV. So after GLD, was there another one?
No worries. Chad also asked if you could look at AR.
Not a stock I'm super familiar with, but yeah, you can't deny that pattern. Now here's the issue. When you look at the DMI, you can see that's extremely high ADX, and it's well above the positive directional indicator. Now, just to be really clear, if you're not familiar with the DMI, when you have the ADX move above 40, especially when it moves above whatever directional indicators on top, positive directional indicator if it's an upward trend, negative directional indicator if it's a bearish trend. But when it moves above that and gets above 40, it's telling you the strongest part of the move is over. Now that's the key. It's not telling you the move is over. That signal is when the ADX breaks back below 40. That's telling you it's done. You're about to reverse. But this is telling you the strongest part of this move is over. Now, could it continue this kind of crawl? You see, we had a couple pretty strong moves, right? There was a strong move there, a pretty vertical move there, and now we've been kind of crawling higher. Could it continue to do that and hit that wave 5 target? Yeah, it could. Could the wave 4 start at any time? That's possible as well. That's the problem when you have an ADX that's that high. That was a very strong move. So it's likely that this isn't done. It just could correct first. Maybe it doesn't, but it could. That's the warning that that high of an ADX is telling you. So I don't know that there's significant move higher without a little bit of rest here, but could it make it to the 5? It could. That's a really strong looking chart. If you're looking for something really long term, I think that ends up higher. I just don't know if it does it in the short term or if it needs a little more time to do it, but I think that stock ends up higher down the road.
Awesome. Thanks for that, Rob. So we have a question here from Mary, more of a conceptual type question. If money isn't going into bonds, where is money going?
Well, see, that's the issue is our money, retail people that are putting money in to institutions, investment companies through IRAs and 401ks, et cetera, they're putting money into defensive stocks like the food stocks that we looked at. Clearly, some's going into metals as well. The big money is coming out of the market, and that's the Federal Reserve, and that's the problem. They haven't officially started. See, I don't trust when the Federal Reserve says they're going to do something. A lot of times I think it's jawboning to calm the markets. To say that they're going to start it in May, why wait till May? Why wouldn't they just start doing it if they feel that strongly about the potential for 2 consecutive 50 basis point rate hikes, and they're going to withdraw liquidity as well, and they say May? I think they do that just to kind of massage the markets without creating panic. Because if they came out and said, we're withdrawing liquidity right now, what do you think would happen in the markets? Were they going to withdraw liquidity in 2 50 basis point rate hikes? You're going to have 1,000 point down day in the Dow as soon as that happens. So I think I don't trust that they're still in the injection phase. I think they've stopped, and they might even be withdrawing some liquidity now. Perhaps, we're seeing that in the market over the past couple of trading days. That's speculation on my part. I could be totally wrong, and the Federal Reserve does wait and do it in May, but they're really worried about inflation. So why would they wait? They've already started raising rates, so they're going to raise rates and still ease until May? I don't buy that. So I don't know. We'll see how that plays out. But that's the problem. The big money is not going in the market, it's coming out. It's our money, retail public money going in through retirement programs. That's what's going in the market now, and it's going to go hide. It's going to find they have to put it to work by law. They can only keep a certain percentage in cash. They have to put that in the markets, and they're going to be putting it in defensive sectors, which is what you're seeing: metals, food, et cetera.
Awesome. Thanks, Rob. So we'll transition back over to YouTube at this point, and Jordan would like to look at Oxy.
OXY?
Mm-hmm.
Occidental Petroleum. So we had a little bit of a pullback in oil, but short-lived, right? And I don't think oil's done going up, and you've had a nice consolidation here. Here's that chart that we were just looking at. What was it on AR, where the ADX had gotten high, and it said the strongest part of the move is over. See what happened? See, the ADX got above 40 here, went down, tried to go again, got to 45, which is exactly where it is on AR, and the upward move stalled. And so it's gone sideways for a while. And so the ADX came back down. Now it's back below 40. So if we can get that positive directional indicator to break back above the ADX, then we could have another run. And I kind of think that's what's going to happen, because I just don't think oil is finished yet. And so I think this is a pretty nice consolidation area here from this vertical move higher. So it went vertically up. At least it didn't come vertically back down. It did the other one where it goes sideways and allows the 10-day moving average to catch up. You got a bit of an ascending triangle there. As I said, that can go either way. It could break down and create the wave 4, or break up and hit that wave 5. The DMI is telling you that was a very strong move, but the key is going to be, can this positive directional indicator get back above the ADX. If it is, then I think you get an upside breakout and you hit that target right away. But it looks like you're going to get a, nearly a 10-point move here by the mouth of that triangle. It doesn't really look that wide when the chart's condensed, but yeah, eight-point move maybe coming out of this. So what that would take you, in the neighborhood of this, the 8-point move, it gets you right to the lower level of the tap box. So I could see that playing out. But remember that positive directional indicator has got to get back above the ADX first.
Awesome. Thanks for that, Rob. The other
It could do that in a day. I should be clear on people that aren't as familiar with the indicators. The ADX is a lagging indicator. It moves slower, but the two directional indicators are very responsive to the day-to-day moves. So if you had an upward breakout day, you could get that positive directional indicator above the ADX in one day, but it has to happen.
Awesome.
In my opinion.
Very good. The other symbol from Jordan from YouTube was XLV.
Oh, okay. Well, that's one of our favorites.
Indeed.
Healthcare sector. And so we see the problem with the vertical moves, right? So we had the nice run, which we took advantage of. Then it went vertical. We weren't in it. We were already out, but we had a nice trade. And, that's what happens when you have these vertical moves. Vertically up, that's not a positive. If healthcare is not going to do well, then that's really bad for the markets, I think. However, it did go vertically. It was trying to break a high. It's not likely going to do that when you go vertical and you're overbought. So come back, reset. Let's try it again. We want to watch these directional indicators, because if that negative breaks above the positive, then all bets are off then, and you have to reevaluate. But perhaps it just needed to come down, set itself, and take another run at it. So a little less decisive on this one, other than the fact that that's why I don't like vertical moves. And when you have overbought conditions and you're trying to break a major point of support or resistance, they just don't usually hold. They just don't. It looked like the one in the EWC was going to, and it didn't either. So let's gather a little sideways stuff here and see if we can break higher. But the person that was asking where is money going, this is one of the sectors. So that's why I'm saying if this comes down, then holy cow.
All righty, back over to Zoom. Susan asked, option expiration being this Friday, will this offer any hint of a directional move? And hope your mom is doing better.
Thanks on my mom. And I believe expiration is Thursday, right?
Yeah, sorry, Thursday.
Yeah, because of Good Friday on Friday. So thanks on my mom. She's still in the hospital, but I appreciate the sentiment. So thank you so much for that. Means a lot. I'm sorry, what was the question about expiration?
Just will this have an impact on a directional move?
I think so, because there's a holiday weekend. So I think Thursday is going to be a really interesting day. And I don't know how the traders are going to, you've got a holiday weekend. You got all this news about that the new variant running crazy in China again. They're locking down. The government warns don't travel to China. We haven't even talked about that as a potential market mover. It's going to get here eventually. We know that. And so how bad does it spread here? Nobody knows. It doesn't seem to be. I mean, it seems to be going the way viruses normally go. Each variant becomes more contagious, but they become less deadly. So, whether or not that's an issue or not, who knows? Who knows how the government's going to react to it, whether it becomes a factor or not, but it's an unknown out there. And so the government seems to be pretty reactionary by saying, stay away from China. That's kind of a pretty big deal. Get out if you're there. Don't go if you're thinking about going there. It's a pretty significant warning. But as far as what happens Thursday, do the market makers square their positions up? If we bounce tomorrow, then maybe Thursday's not a big day. But if we roll over and have another down day tomorrow, then we could have an up day squaring those positions on Thursday going into the holiday weekend. So I think what happens Thursday is going to bear on what happens tomorrow. That's the short answer.
Very well. We still have tons of questions coming through. We are 7 minutes over time, so however many more you'd like, maybe a couple more, up to you.
Yeah, let's do two more. I'm glad to hear that there's a lot of questions, so we'll do two more. And
Absolutely. We love the interaction. And again, just to reiterate, if we don't get to your question, it has nothing to do with the validity. We just only have so much time for this brief session. So please feel encouraged to come back on insiders so we can address them then. So Claudia also passed through that she prays for your mom's health, warm regards. So
thank you.
Pass through those kind words. So we do have two questions on KMI here, one from John from Zoom and one from Sushi on YouTube. Picked up KMI puts as it appears to have a difficult time breaking above 20. Thoughts? Thanks.
Puts is a bold play with the space that it's in. The DMI is still supportive of a potential move higher. You're right that it's struggling here at this 1920 area. So that is an area that is major resistance. So I think it's an aggressive trade, but I can see why you did it. Yeah, if it gets to 20, then I think that's your stop probably, right? If it gets up to 20, then you get out. It's still above the 10-day moving average. And, we'll see. If I'm right on oil, then maybe it does head back higher. We'll see how that plays out. But yeah, you're at resistance right now, which and so you took puts. Now the next support is that you could have a run down here towards 18 because that's the next. This is really just noise right through here. The next major point of support resistance is right here in the 18. And that's also where the 50-day moving average is. You are getting a little bit of separation here between the 10 and 50-day, and that works the same as the 10-day. You heard me say that before. No security in any time frame gets very far away from the 10-day moving average. Well, when the 10-day moving average separates from the 50-day moving average, they come back together as well. So perhaps you have a good short-term trade here. You get a little bit of a move back, but I don't know that I would hang in there too long on your downside trade. If you get a nice quick in and out, then good job, and you might want to consider making that one a quick exit. We'll see what it does at 18, but tricky one there.
So another same scenario here. Jonathan from YouTube asked about Tesla, and Constantine wanted to talk about an adjustment on a Tesla spread.
An adjustment.
Constantine's question says, I want to talk about an adjustment on Tesla spread. And I see you have your hand up there, Constantine, but for this session, we only do the Q&A written text. So feel free to come back on Insiders where you can have a conversation about and more context there.
Okay. Yeah, on the adjustment, I'm not sure, or send a message in support, and I can respond to you in the morning there as well. But as far as this, sitting right at its 50-day moving average, I was asked if I thought it was going to go to 980. I said yes, and it did, or awfully close. When the low was 974, so yeah, it went to 980. I don't know from here. Looking at support right there, right at the 50-day moving average. And I think we got to let Tesla tell us where it goes from here, because it's not in a 5-wave impulse pattern. It's had the move down. It filled this gap that I thought it was going to fill. It's gotten to the 50-day moving average. We're right at 960. So we're right above that, 970 or so. The DMI is rolling over a bit, still slightly bullish. But I think we need to see how it reacts to 960. If it can't hold 960, then it's probably coming back to 800. So, but it could bounce from 960 and head back up higher as well. So this is the key decision area for Tesla right here, right at 960.
All righty. So to wrap things up, if you'd like to take a look at SMH for David from Zoom, we'll end on that question.
Yeah, let's look at that. We haven't looked at the semiconductors in a while. Pretty nice 5-wave impulse pattern there. Wave 4 right at that 61.8% level. Man, the DMI. I'm not as big of a fan on the DMI on downward trades. Our subscribers know this, due to the fact that because the ADX tends to lag a little bit and downward moves can be so quick, as you've seen here. Even that upward move was quick too, but the two directional indicators is where I focus more of the attention, and there's really good separation there. So the sellers are in control here on the SMH, but it's at a point of support and it's not really that much overbought. So could we bounce from here? If it's going to bounce, this is it. If it doesn't, then we're probably going down to this wave 5 target at 215. I think that is likely where, based on that DMI, it's going to wind up. But maybe we get a little bit of a bounce first here, like it did back in March. It bounced and just went up to the 61.8% level, came right back down again. So that's not super positive. And there's tremendous amount of resistance there up at the 280 level. So we're kind of in a bit of a trading range here where resistance is 280, support is 240. Which one gives first? So far, the technicals would suggest that after maybe a sideways day or two that we head lower, but we'll see how that plays out. But yeah, I'm glad you asked about that. We hadn't looked at semiconductors in quite a while. Thanks everybody. All of you that were live streaming, we appreciate that. Time's most valuable asset we all have. We very much appreciate you devoting some of your valuable time to us. We try to make it as informative and educational as possible and a good use of your time. So thanks again for your viewership. Thanks for the comments on my mom. Appreciate it very much.